Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 7th August. Coming up on the show, Trump's tariffs hit dozens of countries as the trade deadline expires. The president also plans on imposing a 100% tariff on semiconductors. We'll give you the market reaction. And Apple announces a $100 billion investment in the US. I'll explain why. So grab your coffee and let's own the morning. OK, let's have a look at what's moving the markets. And President Trump took to Truth Social, boasting that billions of dollars in tariffs are now flowing into the US after new tariff rates on dozens of countries took effect at midnight. This comes after Trump signed another executive order imposing an additional 25% tariff on India over its purchases of Russian oil. The new tariff, which will come into effect in 21 days, is set to stack on top of an existing country-specific tariff of 25%, which took effect today. So a 50% tariff in total. On top of this, he floated the idea of higher tariffs on China due to Beijing's purchases of Russian oil. Outside of China and India, Switzerland is the developed nation whose goods face a whopping increase, up to 39%. President Trump also said that he will implement a 100% tariff on semiconductors coming into the US unless the companies have committed to build in America. The tech industry has been waiting to find out what semiconductor tariffs would look like and whether they would apply to individual semiconductors or to chips built into devices. Additional tariffs could drive up the price of everything from smartphones and laptops to home electronics and more. If anything, though, market sentiment got a boost, as you can see. That's because companies producing goods in the US would get exemptions. The world's biggest chip supplier, TSMC, based in Taiwan, for example, has significant investment in the US. Another beneficiary from this announcement was Apple. And that brings us to the last thing you need to know about before the opening bell. The president's semiconductor tariff announcement came during a press event in the Oval Office alongside Apple CEO Tim Cook, who was on hand to unveil an additional $100 billion investment in research and manufacturing in the US. Well, as a result, it's looking like another positive start to the trading day this week. Following on from yesterday's decent performance, there are some other key factors behind this optimism. There's increased hope that there could be a truce in Russia's war with Ukraine, as the Kremlin confirmed that Presidents Putin and Trump will meet for summit talks within the next few days. Increasing speculation on a Federal Reserve interest rate cut is also supporting optimism in stocks. OK, let's focus in on Apple. And yesterday's investment announcement follows Apple's prior $500 billion investment in US spending, which includes working with partners to build an AI server plant in Texas. Take a listen to Tim Cook.
I'm glad to be here with you today, and I'm very proud to say that today we're committing an additional $100 billion to the United States, bringing our total U.S. investment to $600 billion over the next 4 years. As a part of this, we're launching Apple's American Manufacturing Program. It will spur even more production right here in America for critical components used in Apple products all around the world. And we're thrilled to announce that we've already signed new agreements with 10 companies across America to do just that.
Well, as you can see, Apple shares are on the rise in pre-market. The tech giant said that the new investment includes its new American manufacturing program, which Apple says will incentivize global companies to build critical components in the US. Some of the partners it will work with at first under this program include the likes of Texas Instruments, Broadcom and Samsung. During the briefing, Cook presented Trump with a disc made of Corning glass atop of a gold stand made by a former US Marine who is now an Apple employee. As part of the investment, Apple is making a $2.5 billion commitment to produce all of the cover glass for its iPhones and Apple Watches at Corning's Kentucky manufacturing facility. Though Apple has touted the US roots of iPhone glass before, a portion of what that glass was previously actually made overseas. The two companies will also work to open an Apple Corning Innovation Center at the plant to help develop and engineer materials and next-generation manufacturing platforms for future Apple products. Perhaps most significantly, it looks like Apple is set to largely escape the Trump administration's upcoming promise of a 50% tariff on goods made in India destined for the US. A White House official confirmed that Apple's semiconductor-powered devices, including its iPhone, will be unaffected by Trump's 25% reciprocal tariffs, which came into effect today. The same goes for an upcoming promise of an additional 25% levy related to India's use of Russian oil. That is set to be in place in about 3 weeks' time. Now, iPhones and other similar products will be subject to a separate tariff authority, which has not yet been unveiled. Apple said during its most recent earnings call that it made the majority of its US-bound iPhones in India. Remember, in the past, Trump criticized Apple's decision to move manufacturing from China to India and not the US, saying during his May trip to the Middle East that he had a, quote, little problem with CEO Tim Cook. And don't forget, Apple hasn't been completely immune from the impact of tariffs. In Q3, it said that it took an $800 million hit from them and expects another $1.1 billion in charges in Q4. Now it's time for some of today's trending tickers. We're watching Taiwan Semiconductor, SoftBank and United Airlines. First up, Taiwan Semiconductor is rising on an exemption from President Trump's chip tariff threat. This comes after Trump said he would impose 100% tariffs on chips unless companies are building in the US. Now, TSMC has said it will invest $165 billion in US manufacturing. It's unclear how much manufacturing a company needs to do in the US to qualify for the exemption, though. The US recently imposed a 20% tariff on goods from Taiwan, but said the chip sector would be treated separately. Next up, it's SoftBank, and it's swinging to a bigger than expected profit in its fiscal first quarter, marking its second straight quarter of profit. The Japanese company boosted by gains in its Vision Fund tech investment arm as it looks to capitalize on the AI boom. Still, the company said that its Stargate project with OpenAI, which was announced in January, is taking longer than expected. SoftBank has added more than $65 billion in market value over the past 4 months. Now, finally, United Airlines is resuming flights after a tech issue forced a ground stop at US airports. The disruption had hundreds of flights held at their departure airports for several hours. United Airlines released a statement saying, quote, the underlying technology issue has been resolved, and while we expect residual delays, our team is working to restore our normal operations. Now, the ground stop affected major hubs, including Newark, San Francisco, Chicago, Denver, and Houston. That does it for Trending Tickers. You can track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. Coming up, Disney CFO Hugh Johnston weighs in on the company's deal with the NFL, why he says it's a win for consumers. That's next on Morning Brief Market Sunrise. Welcome back to Market Sunrise. Well, the NFL is set to take a 10% stake in Disney's ESPN ahead of ESPN's standalone streaming launch later this month. Disney CFO Hugh Johnston spoke to our own Brian Sozzi about what the deal means for the entertainment giant. Take a listen.
We feel terrific about the assets that we'll be getting for the deal. The combination of the NFL network and all of what that brings, in addition to that, combining our fantasy football business with the NFL's fantasy football business, plus the ability to market Red Zone. Overall, we feel terrific about that. And obviously, there's 3 additional games we'll be getting as well, which are of significant value to us. So as we think about it from 2 perspectives. Number one is the impact it's going to have on the ESPN DTC business, which we think will be super positive. And then second, obviously, putting the NFL network together with ESPN will create both revenue and cost synergies. The outcome of that from an investor perspective is it'll be accretive by about $0.05 before purchase accounting. So we think it's a great deal for the NFL, and we think it's a great deal for ESPN as well, which is the best of all worlds.
Hugh, I've seen ESPN various estimates in terms of valuation, $25 billion, even as high as $30 billion. That would make this NFL stake up to worth about, what, $3 billion? Is that correct? Do I have my math right?
Your math is correct, although we haven't talked about the value of ESPN or the value of the assets, because what we're doing here is exchanging equity in ESPN for the assets and the income streams that we're getting. So we haven't really put a specific valuation on it. As I said, the thing I can tell you is it's accretive to the Walt Disney Company. So from a financial terms perspective, we're very happy with the financial terms.
Hugh, as you know, Red Zone has a sacred following, very passionate base in terms of that programming. Do you and Bob Iger, CEO, do you envision ESPN talent going onto that platform?
You know, we haven't talked about it at this point. It's probably a little bit too early for us to go there. I know the guy who hosts ESPN, a fellow Syracuse University graduate, by the way, does a fabulous job. So I certainly expect us to continue and, if anything, try to be additive to that capability, because it's such a good one.
Now, the deal, of course, has to get approved by regulators. What is Disney willing to give up to get this approval from the Trump administration, which has not hidden its views on traditional mainstream media?
Well, I'm hopeful we're not going to have to give up anything, to be honest with you. We don't see it as in any way anti-competitive. Actually, quite the opposite. The way we think about it is this is so pro-consumer. It really makes their lives easier. Sports fans, it's a bit of a challenge right now because content is spread across so many different places. And we view this as a convergence that we actually think will make it easier for the sports fan, and in addition, it'll give them the capability that we have as ESPN to produce fantastic content. And in addition to that, with the ESPN DTC launch, we'll be able to bring a lot of new capability as we innovate for the consumer as well around things like multi-view games and personalization of SportsCenter. And in addition to that, fantasy and betting and enhanced statistics. So we view this as super pro-consumer and are certainly positive from that perspective. And as I said, we think it's a great deal for the NFL owners and the NFL players as well. So this is truly a win all around. We're hoping that the regulatory process will go extremely smoothly.
Hugh, $1.6 billion for a 5-year deal for WWE. I'm a WWE fan. It's good to see WrestleMania and other events being on one home. What's the return on investment you're looking for? That also is a very large number.
Yeah, it's a big investment, but we do expect positive financial returns from the investment. So from that perspective, we haven't gone any deeper than that. But the beauty of where ESPN right now is with the NFL, with the NBA, with college football playoff, SEC, and NHL, we have so many, such a good load of volume of really high quality content. We can pick and choose where else we want to be. And as a result of that, we're in a good position to strike good financial deals for ourselves. So we expect this to be another good financial deal for ESPN.
Okay, coming up, we'll take a look at some of today's market movers as second quarter earnings season rolls on, with more than 100 S&P 500 companies reporting this week. That's next on Morning Brief Market Sunrise. Okay, it's time for market movers, and once again, we're going to focus on earnings. Okay, let's kick off with Big Pharma and Eli Lilly. Now, as well as earnings, the company released details of tests it's done on its weight loss pill. And the share reaction, well, it's been pretty severe. Even though they showed that weight could be reduced on average by 11%, that still fell well short of market expectations. And look at the share price, down over 11% right now in pre-market. Now, let's have a look at the actual figures. And revenue for Eli Lilly came in at $15.56 billion for the quarter. That was better than expected. The market was looking for $14.7 billion. And earnings per share, that even completely smashed expectations. The expectation there was for $5.57 per share. They actually came in at $6.31. But despite this, as you can see, shares are down quite a bit in early trade. Now, it's worth remembering also that the company's second quarter report has arrived amid a worsening political environment for Big Pharma. Just last week, President Donald Trump sent letters out to Lilly CEO David Ricks and other top pharmaceutical executives saying that companies have until late September to cut certain drug prices in the US, or else the administration will deploy every tool in our arsenal to protect American families. So a lot to watch out there on Eli Lilly's results, and we'll bring more throughout the day on Yahoo Finance. Okay, let's move on to ConocoPhillips now. And revenue came in, the earnings per share number actually came in at $1.42. That's better than expected. The street was looking for $1.34. These results have come in as we've seen we're in an environment of falling oil prices. West Texas Intermediate over the first quarter was trading roughly $10 to $12 higher than in the second quarter. However, it's worth remembering that ConocoPhillips has extensive oil and natural gas resources that it can develop, earning substantial profits from them. And even if the price of oil declines, it could be able to weather that storm. And as you can see, shares are higher in the pre-market, up almost 2% there. Okay, finally, let's take a look at global entertainment and media company Warner Brothers Discovery. Revenue there came in at $9.81 billion. In fact, Warner Brothers has topped Wall Street estimates for quarterly revenue. It's been boosted by the international expansion of HBO Max and blockbuster releases, including US top grosser, a Minecraft movie, the one starring Jack Black, of course. It's also worth remembering that Warner Brothers Discovery will be splitting into two. The company hopes by mid-2026, the streaming and studios division will be called Warner Brothers, and the global network segment will be called Discovery Global. And this is all part of its attempt to navigate an industry-wide shift in consumers' viewing habits from traditional cable to streaming. Okay, one very final one to look at is Krispy Kreme. It's come out with second quarter results this morning and they've missed expectations, I'm afraid. Made a loss on per share of 15 cents. The market was looking for a loss of just 12 cents. And revenue came in slightly below expectation at $379.8 million against expectation of $380.2. And shares there down over 15% in the pre-market. Now, the struggling donut chain did get a recent boost, though, from the meme stock rally on Wall Street, but it's still down more than 65% year to date, and it will be more by the close of today if it carries on like this. Now, Wendy's also is set to report second quarter earnings ahead of the opening bell on Friday, where investors will be closely watching US same-store sales. Now, this all comes after McDonald's saw US sales return to growth in the second quarter. Yahoo Finance's Josh Lipton spoke to one analyst about what it means for the broader sector. Take a watch.
This brand's as relevant as it's ever been, and you're going to see in about a week or so kind of a nostalgic return to McDonald's land and some of the characters that maybe you and I grew up with, the Grimace and the Hamburglar, and some interesting innovation around beverages, meal deals. Clearly, the chicken snack wrap that launched about a month or so ago has been performing very well at a $2.99 price point. We'll probably see, Chicken Big Mac make its return in the fall. And yeah, a lot of innovation that, continues to focus on chicken primarily, but also potentially some beef items as well as beverage items that they'll be testing, as we work our way into the end of the year here.
There's a broader question, Andy, I had for you relating to your space and some of the names you cover, like McDonald's. When RFK Jr., Andy, was nominated and then approved to lead HHS, there was a lot of hot talk, Andy, including I remember some analysts who came on the show who said, oh boy, if you are making salty, fried, delicious food, Andy, you might have some problems here. What happened to all that? Was that ever a legitimate risk for investors?
Not really. That's, seemingly been focused on the food manufacturers and obviously certain areas like colorings and dyes and things like that. Restaurants, did come into the scope of the GLP-1s 2 summers ago in the summer of 23. And there certainly was some impact on the stocks. They did bounce back, kind of that fall, but and we really haven't seen any noticeable changes in operational trends or anything as GLP-1s now approach, I guess, about 5% of the population. So we'll have to continue to monitor that. But no, the Make America Healthy Again has kind of kept, kept away from the restaurant industry, given the choices and variety that restaurants provide. And, the GLP-1 saga will continue to see unfold. But, overall, chain restaurants continue to gain share, and the category overall gains share in total food dollars when you include, food at home and food away from home.
Okay, for our call of the day, let's take a closer look at oil. Now, it's fair to say that today oil prices look like they could be quite volatile after having endured a sell-off yesterday. Both Brent and WTI, as you can see, falling sharply. Now, as I mentioned earlier, President Trump upped US tariffs on India to 50% in retaliation for its purchases of Russian oil. Now, India has largely refused to stop buying Russian oil due to the fact it's difficult to find a substitute. It's estimated that it buys around 2 million barrels a day. Indian officials labelled the threat unjustified and reaffirmed its commitment to protecting its economic interests. Trump wants to put economic pressure on Russia to end the Ukraine war, moves which sent the black commodity to an 8-week low on Wednesday's session. Now, for oil traders earlier in the week, the focus had been on the oil cartel OPEC+. It made moves to hike output by 547,000 barrels per day in September. The increases add to oversupply concerns surrounding the US's oil consumption. Now, OPEC+ justified the move by citing a resilient global economy and low stockpiles. But there are worries that the group will increase supply again after September. Okay, let's get a final check on the markets before we go. We start with Asia, where it's been a relatively positive day. It's worth noting that Asian semiconductor-related stocks traded mixed today after President Trump announced he would impose 100% tariffs on chip imports, with an exemption for companies that are building in the US. Tokyo Electron fell heavily, but the likes of TSMC and Samsung climbed. Moving on to Europe now, and shares here have got a boost after the Kremlin confirmed the summit talks between the Russian and US presidents. We've had upbeat earnings from some of the region's biggest companies, and that's helped boost sentiment as well. That's even after German industrial production suffered its biggest drop in almost a year, and that's clearly another setback for Europe's biggest economy. The FTSE is down there. The Bank of England actually has just announced interest rates cut of 25 basis points, which was expected, to 4%. They had some interesting commentary on tariffs as well, saying the impact wouldn't be as bad as they thought on the UK economy, but still would impact growth by 0.2%. And in the US, it's green across the board too, I think. Yeah, there is. And in addition to grappling with the latest trade policy shifts, Wall Street will receive new data on weekly jobless claims as well. Okay, that is it for Market Sunrise for this morning.